Hi, my name's Chris Kaufman. I'm president of Parallax Financial Research in Redmond, Washington. And today's talk is going to be on the timing of critical market events using complexity theory. I call it financial seismology, and I think you'll understand why when we've gotten a little farther along. Parallax's goals have always been we've been in business 33 years. Our goals have been to apply the scientific method to understanding market dynamics. And when I came into this business, it looked like the technical analysis, I guess is what people call it, was an observational theory and did not have the backing of some concrete um, theoretical underpinnings. So we decided to embark on finding what the theory was behind technical analysis and see if we could improve some of the indicators. So uh, simply goals were to employ science to rebuild the fundamental and technical analysis disciplines. It's a big job, and in order to do it, we had to identify what the theoretical basis for technical analysis was, and we'll get into what we've discovered. And then, with any theory, you often get predictions of what should be observed. Well, simply go to the charts, look and see whether the observations that the theory predicts are there, and then iterate between the two. Update your theory based on what's being observed. And then the idea behind that was to construct better indicators, indicators that were more in sync with the theory. And then, as in any scientific endeavor, use statistical testing to decide whether or not the indicator or predictor you're building has any validity. And then, more than anything else, really, to dispel the notion that market dynamics are somehow mysterious or magical. There's been a lot of that in the last 100 years, and I'll show you some of it. Then bring the predictors to market, put them in software, and put them on professional platforms and educate managers. So I think in large part we've been doing that, and I think you'll enjoy the results. So when I came into this business in the late '80s, early '90s, and started picking up books on technical analysis, all different kinds. There was no stone left unturned. But I ran into a lot of the same words, which were a bit disturbing. The word magic showed up a lot of times, and magic T formula, mysterious forces that trigger events. Magic is real. Anyway, this was, to a scientist, magic is not gonna work. so, so I set about understanding each of these unusual theories and trying to find the kernel in each one that was non-random, something that was being observed that could not statistically be called random, and then the goal was to try to find what was behind it. So this is our overview sheet. We'll spend a little time on this. So we call anything that's has to do with understanding markets, market dynamics, and as everyone does, we divide it into fundamental value and I call it crowd effect, but technical analysis is basically crowd effect. It's what are the investment agents believe? Are they optimistic, pessimistic? Are they chasing price? What are they doing? But let's talk about this for a bit. Over on the left side, fundamental value is a pretty simple concept There are a lot of great books on figuring out fundamental value, discounted cash flow methods. Graham and Dodd was a go-to for us. But it occurred to me when I started this project that you have to look at all the factors that are important to value a company at the same time. Because if you look at just price to earnings and then price to book, and you look at them one at a time, you're not really getting the whole picture of the company. So I had just come off of using nonlinear regression models in geophysics. I spent about 15 years in geophysics, and my underlying background's in physics, my degree's in physics. And it occurred to me that these things called neural nets, AI, you call them now, deep learning, some of the other names for it, were perfect for this particular task. So I gathered up the factors that were important, that authors had identified as important to valuing a company, and they're labeled there: sales, earnings, cash flow, book value, what industry you're in, interest rates and inflation, sort of the background macro factors, how much debt, what your margins look like, and then accumulated years and years of data on thousands of companies, and trained neural nets. So we train neural nets in each economic sector, and some of the sectors are so big you actually have to go down to the industry group level. So we trained a set of neural nets to tell us what the price should be for a company. And so if you see this little diagram down below, you see these little purple lines here. This is what our neural net would say the price is worth for whatever this company was. So, and the difference between where a stock is trading and what its value is due to the effect of the crowd. How far out does the crowd want to discount the future? 1 year out, 2 years out, 3 years out? If they're very excited, they'll discount further and further out. But when something bad happens, you'll get a rush back to value. That's happened quite often. Sometimes even a bit undervalued if there's enough fear. So it's important to know what value is, but we have to understand that there's two components here. There's what the actual value is and what the perception of value is. And that's determined by the crowd and their degree of optimism and pessimism. So on the other side, very interesting, and this is after many years of R&D, we found that there is one theory that takes care of everything that's observable that you would call technical analysis, and that is, it's called complexity theory. And complexity theory is basically a theory that governs multi-agent systems. A multi-agent system in our case would be each individual that participates in a market, buying and selling securities, would be an investment agent. And there are many of them, so it's a multi-agent system. And are they connected? They should be networked together somehow, and in complexity theory, we expect it to be, the agents to be networked. Well, they're basically all networked through price. We get to observe price every day on, either on television or in our applications that we use online. And by watching price, we are essentially connected to every other investment agent that's watching that same security. So there's a large network of agents. And the other requirement for complexity theory is that those agents need to be obeying a simple set of rules. And there needs to be feedback. So we thought about this for a long time, and there's certain similarities between investment agents and birds flocking. And so the rules we came up with, the simple set of rules, is investors pursue price. They chase price. If something's moving, if some security is moving, it's going up strongly in price, investors want to jump in. They'll see it, they'll want to jump on it because they want to ride it higher. And the other effect, which is maybe less obvious, is that investors are attracted and repulsed from key prices. And this really comes into effect because we're very good at seeing patterns. Humans are, and if there's a prior high or a prior low, investors tend to focus on whether that level is taken out or not. So it tends to be that orders tend to accumulate in those areas that are linearly connected. Some trend line, you can connect a few dots, that tends to attract order flow. So you might get out at a point. If you break out of a line, you might get in. So the buy or sell orders tend to be placed on these geometric locations. But complexity theory predicts that. This little diagram up here shows that through positive and negative feedback, positive feedback in our case would be buying because it's going up or selling because it's going down, attracting more. If an investor buys because the stock's going up, and a number of investors do this, then the price goes up more, and that attracts attention, which brings in more investors that buy, and then the price goes up more. That's what we call positive feedback, and that can work on the downside too. A downward movement would be a little scary and would scare some people into selling, which would push the price down further, which would then be noticed by others that are holding that security, and they might be encouraged to sell, and so on. So the positive feedback is sort of a runaway effect. And on the other side, negative feedback is just the interplay of supply and demand. On a single security, if supply and demand is in contention, you tend to have negative feedback. Every time the security goes up in price, the supply dumps it. Every time it comes down, the demand buys it, and you have this interplay, which is kind of like a thermostat. So the feedback mechanism in complexity theory, through this set of agents with simple rules, creates an effect called emergence. And emergence is, in our case, the emergence of geometric pattern, which is, for instance, with birds flocking, you get some interesting patterns. You get murmuration patterns, or what look like geometric patterns, just like you do in markets. And so complexity theory, with these couple of simple rules, really explains almost everything we see in technical analysis. So we can go further. If we have an underlying theory, then we can push it and say, okay, what does that theory really predict we should see, and let's go further and see if we can't create indicators or upgrade indicators that do better at predicting price movement. So we're going to go ahead and talk about some of that. This is just a diagram showing the basic concepts of complexity theory, and where I've highlighted in green, those are in numbered. Those are the sort of the key manifestations that we see in markets: self-organization, and we see some nonlinearity because of feedback. So these two areas, pattern formation up here, and emergence, and then chaos theory, which is the science of feedback systems, plays into this nonlinear part of the theory. So we'll come back to that. What we found is that basically this idea of feedback and emergence that complexity gives basically four manifestations of the effect of the crowd. The one that's easiest to understand probably is cycles. And technical analysis has names for each of these manifestations. Price cycles are very commonly talked about in market lore and market discussions. Critical phase transitions are things like a trend change. Okay, you have a top or bottom. there's some big change in trend. An exhaustion of a move would be a technical analysis name for it. This is where we'll come back to critical phase trend. We're going to talk about all these, but trend change is something that market technicians talk about. Self-organization and emergence these are the scientific names for these categories. But trend lines, patterns, flags, pennants, channels, head and shoulders, Elliott wave, all these terms in technical analysis pertain to self-organization and emergence in terms of the theory. And then the favorite of all is chasing price, which we call stochastic pursuit. It's not a random walk, which would be a stochastic process, but pursuit means you're chasing. So that's responsible for some of the other observables like fat tail distributions. And but anyway, most indicators like accumulation distribution indicators or a moving average even would pick up on trends. This is a more common area of understanding in technical analysis. What's trending today? So there's trend change, trend lines, and trending, and then cycles. So those are the four categories, and each of those categories we've applied some higher order science, and that comes with complexity theory and some of the subcategories to build indicators that are more focused on the underlying theories. So what we call precision turn is our cycle tool that's more focused on the underlying theory. Extreme Hurst is focused on these critical phase transitions, and we'll get into that. Smart Channel is focused on determining, statistically determining trend channels and trend lines. And then volume trend is our way of identifying strong trends in markets using volume and volume change. So we'll get on to the next set here. So pursuit of price in feedback loops is the key to forecasting. Okay, so let's talk about that, and then what I'm going to do is separate these discussions into blocks of videos. So we'll go through this block, and then I'll stop, and it'll be the overview plus this section, and then we'll have additional sections to continue the talk. So pursuit of price. Okay, so what's a feedback loop? I think most people have encountered negative feedback. What is feedback? Okay, so feedback is when the outputs of a system are fed back in to make new inputs into a system. Simplest one is the furnace in your house and the thermometer system. So it gets too cold in the house, thermometer triggers the furnace to turn on, increases the room temperature, eventually triggers the thermostat to turn off the furnace, and so on and so forth. So it keeps it in a stable state. This little ball sitting in a well, it sort of illustrates if you moved it to the side, it would always come back to the center. So it's a stable state. Positive feedback is the dangerous one. Positive feedback, part of the reason I call this financial seismology is that with earthquakes, you have a small amount of stress released by rocks breaking at depth on a fault, which loads the stress onto other areas of the fault, which then might be near breaking, and then they break and then load additional areas, and you get an earthquake. Well, you put a microphone near a speaker, and the output of that speaker is fed into the microphone, amplified, and comes out through the speaker again, back to the amplifier, and you get a really awful sound. So in markets, what we're contending is that through local action, in other words, investor agents doing their own thing, um, buying and selling, they are inadvertently self-organizing uh, into these positive, participating in a positive feedback loop, which will reach an extreme point. And those extreme points we call, in science we call them critical points, where just a tiny change in the system can cause a huge global change. And we'll get to that. But anyway, just to go back to markets for a minute. Negative feedback would be in a market would be, here's an intrinsic value, let's say, of a security, and at some point it becomes overvalued in price, and people recognize it and start to sell, and then if it becomes undervalued, it's recognized and people buy. So this is the value oriented. We love this to be the only thing that goes on in markets, where you just where you're always trying to find equilibrium by negative feedback. Slightly over and slightly undervalued brings you to a more rational value. But unfortunately, that's not the end of the story. And what I advise managers to do is to pay attention to the crowd. The crowd will buy because it's going up. And if it goes up more, they'll buy more, and they'll keep chasing it. This pursuit of price can lead prices far away from value. And it can do that for a long period of time. Events such as COVID or the 07-09 period, or the dot-com bust, periods like that where there's a macro event that occurs, it will kind of be like a musical chairs event where whatever the price is, however far it is from its intrinsic or fundamental value, it'll run to it. And we've seen that over and over. In fact, COVID, when COVID hit, the market moved exactly down to fair value. If you added up the valuation of all the stocks in, say, the S&P, the market ran straight to value from where it was. And then once it figured out that this wasn't going to be a long-term effect, it went right back to where it was, and it's climbed higher. So anyway, these are the two kinds of behavior. And what does it look like on a chart? So we use this, talk about this Hurst exponent because it describes it's used to describe feedback, how much feedback is present in a signal. But, the easiest way to understand this is trend persistence and mean reversion. Mean reversion means that the market is running back to the average way more than it should if it was just moving randomly. So a very small Hurst number is looks like a very, very jagged chart that moves sideways with a tendency to always come back to the average number, the mean. And as you move up in Hurst numbers, when you get to 0.5, this series here is a random series. And what I like to say about this is that if you have a price series that's random, there isn't any measure any measurement you can make of a random series that will tell you what's going to happen next. So the predictive, the predictability of this h equals 0.5 series is 0. You can't predict anything from measuring it. And whereas in a mean reverting environment, you can make predictions, and then this high Hurst number here is we call heavily trend persistent, and you can make forecasts based on the past. And that's what we want, right? We want to be able to measure something in the past that tells us about what the future will hold. So the farther away we get from random, the more predictability exists. Okay, and just to emphasize that, I've made this little spectrum here of Hurst numbers. So around the middle is a random area, and when the Hurst numbers start going up, You get into increasing predictability, but more and more trend persistence. The markets become smoother. And if you had reached the ultimate end of this, which is at a value of near 1, you would get almost a straight line. It would be perfectly predictive. Okay. On the mean reversion side, same thing. The lower that number goes, the more zigzags you have, the more reverting to the mean, the more predictive it is. Now, what we discovered was that right at the ends, where you get extreme values of this Hurst exponent, and either extreme high levels or extreme low levels, the markets actually hit a critical point. And the critical point in science is very, very well defined, like the boiling point of water or the freezing point of water, most common critical points that we experience. Markets have the same kind of critical points, and when you reach the high end of the Hurst band, if you're moving up into it very persistently, when you reach that extreme high end, the market will suddenly break. It will stop going up. It will go sideways. It will retrace. It will just not go up anymore, and with a very high probability. And same with trend persistent down moves. When it gets to this high level of Hurst in a downtrend, it stops going down and goes sideways or goes up. And on the mean reverting side, this is like a tug of war between supply and demand, which reaches the point where somebody's going in the mud. Either the supply wins or the demand wins, and you go shooting off into a new trend. And so these are very well defined points. We're going to talk about those in the next section. One of the things I found is sort of an answer to the question, well, where would price have to go today to register certain levels of Hurst? Well, on any given day, where would it have to go to say that you've reached an extreme level? Well, I can figure those out and plot them. So these little bands are, call them Hurst bands. They're every 0.05 in Hurst, and basically you're saying when you're in the blue area, you're in the mean reverting zone. White is the random area. Green or red are trend persistent areas. And what you'd like is the market to be trend persistent upwards, which it is for a long period here. But you don't want to get into this extreme end. When you get up into this extreme end, well, you get the trend suddenly ending and reversion back to the equilibrium area. So that's something to keep in mind. We're going to talk about that again later. And so price pursuit, one of the questions that always comes up when technicians are discussing their tools is, the fundamental guys think, oh, there's no such thing as technical analysis. And there hasn't been a lot of proof that technical analysis is valid. And so, but what is it? It's just looking at charts. And what you have on a chart is you have price and you have volume. So a very simple, I came across this very simple way to prove that technical analysis really is a valid pursuit. And that is, okay, if you identify 4 different conditions going from one price bar to another, if you go from yesterday's price bar to today's, well, you could go up in price and up in volume from yesterday. Let's just say daily for convenience right now. It could be any scale. You could go up in price and down in volume. So volume goes down, but price goes up. You could go down in price with volume up, or you could go down in price and volume going down. So if you have only 2 observables, you have 4 categories of behavior. So what I did was I used a visualization tool that was developed by, it was published in Barnsley. I forget who developed it. It was somebody developed it before that. But what you can do is identify these 4 categories on a square and go back through, say, the Dow Jones, all the way back to its inception, and you can make a picture based on the everyday state of price and volume. So if you have a price up or price down, volume down day, or a price up, volume down day, whatever state you're in, there's a point that gets plotted on the graph. Now, if the sequence of price volume categories is random, these ABCD categories, if they occur randomly, then the picture that's drawn in this square is a completely random picture. There's no pattern to it at all. Now this was developed for long DNA sequences. It was suggested that DNA sequences could be represented. There's 4 amino acids. It could be represented on a square like this. And in the case of DNA sequences, you have a non-random sequence of what is it, A, C, T, and G, something like that, the different genetic components. And it was suggested that you could make a catalog for each not necessarily human, but each animal, each creature that has DNA, you could make a pattern like this using their sequence that would be unique. Make a catalog so you could easily identify, what a particular creature was. So anyway, we've adopted this CGR visualization tool to apply to markets. So here's what would happen if you had a random set of these price volume categories. You'd have no discernible pattern. But instead, when I run the Dow Jones price series through it, I get what look like little fractal Sierpinski gaskets. It's a fractal pattern that shows up here. And so the market is non-random. There is a sequencing of price and volume behavior that's meaningful, and that's interesting. So it basically proves that there's something to it. And so we were, the next question is, well, what is this sequencing that makes a difference? Well, we found out is we were looking at basically 3 standard deviation moves in price and what preceded those big changes in price in the Dow Jones series. And we looked basically at what happens 3 days after you have a state A or a state C, 3 days forward. And so this graph shows that the largest 3 standard deviation or more up moves occur with price up and volume up days preceding. So in the 3 days before the big event, you had price up with volume up, and very few events that actually went down 3 standard deviations had that setup. And if you go to the other end, the big down days were preceded by this state C, which is price down, volume up. So what's common with both of these extreme cases? Well, volume is going up. And that's again pursuit. When you have pursuit of price, then volume should increase. You're bringing more people in because they're noticing that security's moving, so they would be attracted to come in and buy. So you should see a swell in volume. So basically this says, let's change the accumulation distribution indicators so that they don't pay attention, they don't move when volume is declining. So that's how we could fix an existing indicator and make it more tuned to the theory. Well, so here's an example of what we call volume trend. Volume trend looks at whether volume's increased, bar over bar, but we also look at multiple scales. So we're looking at the 2-bar average volume over the prior 2-bar average volume, 3-bar, 3-bar, 4-bar to 4-bar. We look at a few different scales and combine those. And if volume is moving up on any of those scales, it'll move this line down here. And if it's not moving up, the line doesn't move at all. If the volume's declining everywhere, this line does not move. So, so here's a price series where you see a large jump in prices here, but the volume is declining in that move up. So this line doesn't move. And again, here and here, just, you know, 3 cases where, actually 4 cases, where just all the rallies are on declining volume. So this line here shows a more true picture of what's really going on in the market. Because remember, this is forecasting. Increases in volume is forecasting that whatever price move was coincident with the increase in volume, that might likely to continue. So, and this opens us up to being able to look at divergences as well, which is what I've got up here. Here's this volume trend line. So this down move happened with very light, with declining volume, and it's so abrupt that the angle between this decline and this line up here was so so large that we found you could signal a divergence, and I believe that starts at about 15 degrees difference between the 2 lines. And a divergence means that this is likely a false move, and you should heal that that down move in short order. So this again is the concept was take indicators that already exist, look at the science, what should we do to the indicator to make it better, and then improve it and put it back out there. And so that's an example of how we've done that. Here's another example with a divergence in it. Here's a rally on declining volume. Here's the volume trend line, and this little triangle shows where there's enough divergence to signal. And here the line's flat. There's no increasing volume in this up move. So this divergence would predict that in short order you should get back down to where you started the divergence from, and it's exactly what happened. So the way we look at this is that this volume trend line should help to keep you in a trade a little bit longer, because it tends to be that these false rallies or false sell-offs tend to throw people out of positions. And we can actually measure a predictive edge. Now we'll get back to what we mean by edge, but very simply, if you flipped a coin, you'd have no edge. 50% of the time it'd be up, 50% of the time it would be down, right? If you have let's say a game at a casino, the casino knows that they have, say, a 2% edge or a 3% edge on every slot machine. Maybe it's more, I don't know. Which means, let's say they have a 5% edge. It means 55% of the time they're going to win, 45% of the time you're going to win. So if you play over a long period, the law of large numbers would suggest you will just continually lose money. We can measure an edge in similar fashion here. What edge do you have from a signal? In this case, a divergence short, that little red mark that you saw on the last slide. Those, if the angle is at least 14 degrees, it's got about a 10% edge downwards, meaning you've got a 59% chance of it dropping, and only a 41% chance of it going, continuing higher. The positive negative just refers to direction, so this would be a downward move and this would be an upward move. So 15% edge when you have a divergence at a bottom, gives you a 15% edge. So you have now a 65% chance of going upwards versus 35. So that becomes very important. Anyway, I'm going to wrap up this particular set of this particular introductory set, and then I'll continue presentation on the next um, video. Thank you.